Topic for today, international debt and financial crisis. I think the main point for today, having discussed, the global financial system, the dollar exchange rate system, today's discussion is why the global financial system suffers from sort of a twin crisis, debt crisis and financial crisis. These are related. So that the author calls it debt finance predicament. And this textbook gives 3 different cases for either debt or financial crisis. One in the early 1980s. So this textbook gives 3 different debt and financial crises. One in the early 1980s. Okay, second, in the 1990s. And third, global financial crisis. So these 3 different cases, this textbook, we are going to look into and discuss how these 3 different crises differ. Okay, the first wave of crisis better be called debt crisis rather than financial crisis. So it began with debt crisis. So debt crisis is more limited to developing countries. Okay, it began with a crisis in the developing region only. Okay, and second wave of crisis, which is more related to not simply debt, but financial crisis, which is balance of payments crisis. Okay, but the outcome is same. Okay, outcome is same, either debt or balance of payments. So second wave of crisis in the 1990s happened in Asia, although it spread out to different regions. It began in Asia. It better be called balance of payments crisis rather than debt crisis. So Asian financial crisis is balance of payments crisis. Okay, still a little bit different nature, okay, compared to the debt crisis, the first wave of debt crisis, which occurred in Latin America. The first wave of crisis mostly in Latin American region. Okay, some African countries, mostly in Latin American region. First wave. Second wave, mostly Asian countries, right? And third wave, final wave, which is more current, global financial crisis. This time, which raged in 2007, 8, 9, right? Just several years ago. It began in America, right? Began in America, then spread out to the entire globe. So question, what do we learn? What do we want to learn from these sort of a different types of crisis in different regions, right? And number one lesson, I think that financial crisis is not a problem of developing countries alone. I think that's the number one lesson. Because we had like a mistaken notion of these financial or debt crises are thing of the developing countries. You're mistaken about that. Okay, and probably finance is becoming rapidly globalized, right? So financial crisis is moving from developing countries to the advanced countries. And I think it could mean many different things, but first, I think more I think much more bleaker for developing countries. I think that's true. But even advanced countries are not free from this debt finance crisis. Okay. Now, some basics. Right, global financial crisis. I think we have learned global financial system is defined by capital mobility, right? And the coordination of currency exchange rate is important, right? And that, I think, what is that? Why developing countries suffer? This problem of that. That is the gap of balance of payments, right? This is a recurring problem for developing countries. So development for developing countries, I think at the end of the day, comes down to this question of how to fill this gap of balance of payments, right? Because they are spending always, right, bigger than incomes, right? So to develop many developing countries without incurring debt, they have to somehow fill this gap, right? Either in the form of assistance or aid, right? Or foreign investment, right? I think in the past, developing countries, they rely more on assistance, right? That's the debt problem, assistance. But over time, additional tool was available for developing countries, which is foreign investment, because of the development of financial markets, right? But even foreign investment causes a lot of problems. So like official assistance, foreign investment, both types didn't help developing countries develop, right? This author calls it debt finance predicament, right? This is a recurring problem for developing countries. But he asks, is this a problem of developing countries alone? Global financial crisis indicates it's not. This is a problem of the global financial system, common problem facing the global financial system. This is a vulnerability of all nations on the entire globe. So first, LDC debt crisis. Like I mentioned, the first wave of debt crisis, I think it's worthwhile to study a little bit what happened, what caused the debt crisis at that time. I think the first LDC debt crisis, I think, began 1982, right? When Mexico announced it is going to default on its debt, right? They were saying that they no longer be able to, right, pay the debt. So then Brazil followed, right? Brazil, Mexico. Then what were the reasons? What were the causes behind the first LDC debt crisis? I think this textbook, if you read, in terms of the global financial system, I think the very beginning, in terms of global financial system evolving, always 70s is important, right? 1970s, right? The energy crisis, right, happened, but the energy crisis, I think by default, sort of sped up the development of financial market, recycling of petrodollars, right? Recycling of petrodollars sort of deposited in Western banks, commercial banks. And Western commercial banks, again, lended to developing countries. Right? That's how the initial development of global financial market. And the first LDC debt crisis, I think number one reason is it was a consequence of so-called early stages of financial globalization, right? Which is, recycling of OPEC petrodollars. And Latin American countries in the 1970s, right? So the money was available from, Western commercial banks. And Latin American economies, they were pushing for rapid economic development. There were huge projects going on in Latin America. And market deregulation. And also this author talks about changes in technology, right? Technological change made it possible. The financial transactions, massive financial transactions possible due to technological change. Like I said, recycled petrodollars, right? So all these, market deregulation, technological change, recycled petrodollar, all this, right, contributed to the development of early stages of financial globalization, right? And this, I think, led to the first debt crisis, right? So logically, I think he sort of and negative real interest rates, which means that because there was so much, money, dollar available from Western commercial banks, these Latin American developing countries, they enjoyed negative real interest rates, right? They sort of borrowing money from Western commercial banks. They earn profits, and these commercial banks, and U.S. government, they were encouraging Latin American governments to borrow these from Western commercial banks. And corruption is also involved, always, right? Borrowing, lending, government borrowing, always a lot of corruption involved, right? Recently, there was interesting news about Turkish Prime Minister. Turkish Prime Minister and his son was caught on tape, right? Their conversation was caught on tape, right? Did you hear the conversation between the Turkish Prime Minister and his son? They were discussing how to stash, all this cash illegally they obtained, right, from government business, right? I don't know how they got this money, but the money, the amount was staggering. I mean, was like $1 trillion they're talking about. So they were hiding this $1 trillion. Maybe over several years, they obtained this money, right, from illegal, transactions. And when these developing countries borrow money from IMF or Western commercial banks, I'm not saying 100%, but in many cases, IMF and even commercial banks, they give some kickbacks to those who are handling this business. Usually, politicians or leaders, or sometimes president in the developing countries, right? The president of Ukraine, you saw his house, right, on TV. So again, same thing, right? There was huge incentive for the leaders in these developing countries to borrow money from, right, Western commercial banks, and later from even the IMF, right? was a good thing, right? It was a good thing for developing countries in the first place. But the way they handled it, they mishandled it, then I think that led to the debt crisis. The question, right? Do loans lead to economic growth in developing countries? Right? I think at that time, in the 1970s and early 80s, I think especially neoliberal theories, their theories, I think suggesting that yes, I mean loans, official development assistance, I think one way of economic, development. And at that time, there were a lot of investment opportunities, including Latin American countries. But later it became, right, debt trap. And debt trap means that, I mean, they needed additional loans, right, to sustain interest payments on earlier loans. And that continued to grow. And creditor banks also in trouble, right? And IMF steps in, and their debt management policy, I think we need to look into this a little bit, right? And the official, policy proposal for these developing countries, spending cuts, and they reschedule that, and or they lend new loans. And what kind of policies LDC implemented? How do LDC look at this? First, LDCs, they try to reduce imports and increase exports, right, to generate income. But economic growth rates slow down, and the situation, right, grew worse and worse. Only Korea, I mean, this textbook points to Korea and Turkey, and how Korea and Turkey, only Turkey and Korea recovered from that crisis. And except Korea and Turkey, all other countries just accumulated debt and stuck in debt trap, right? Deeper into budget deficits in other countries. The U.S. policy, I think, U.S. prescription for these LDCs was to prescribe, again, market-oriented, policies, market-oriented, structural changes, with additional loans. This is a policy called Baker Plan in the early 1980s. But this didn't work. Baker Plan didn't work. Developing countries didn't get out of the way. I think the main reason why most developing countries stuck in debt trap, despite additional loans, despite market structural changes, right? Since the 1970s, throughout the 1980s, even into the 1990s, why that continue accumulating in developing countries? This recurring phenomenon Maybe Korea is an exception, but mostly most developing countries, why they suffer from this debt, right? Debt trap. It's a difficult question, right? But you know, U.S. Recommendation always you need to open up, right? That's U.S. recommendation, right? To get rid of that, you need to open up, be integrated into the market economy, global market economy. That's I think continued message from the United States. You know, Baker Plan or Brady Plan later. But the problem is, I mean, doesn't work, right? Doesn't work. 70s, 80s, 90s, developing countries, they accumulate debt, right? Debt after that, right? No solution for this actually, right? And I think this author at the end mentions very important thing. Why developing countries continue to fail? Particularly, we are talking here about the 80s, right? The 80s, we are talking about the 80s. 70s, like energy crisis, you know, a lot of dollars available, right? Funnel into these development projects in many developing countries, right? That's how that was accumulated in developing countries. And at the end, I think at the end of the day, many projects turned out to be failing, right? Many projects that looked very prospective in the beginning, right? Looked like huge investment opportunities in the beginning, but turned out to be a huge failing projects, right? That's how many developing countries you know, could not pay back the debt, right? And important reason, I think, he talks about very important thing here. Commodity price collapse, right? I'm not saying 100%, but very important reason why developing countries, many projects, development projects, why it didn't lead to profits. I think because of this commodity crisis in the 80s, particularly in the 80s, right? And oil price collapse, right? Commodity in general, right? And oil in particular. So I think we need to analyze, right, this very carefully. Commodity price collapse and oil price collapse. Very important reason. Then he keeps, I mean, he also points to recession. Many advanced countries were economically in recession, right? So that they could not, you know, open their markets to goods from these developing economies. This was another reason. And corruption in the developing countries. Right? I mentioned this, corruption in the developing countries. In the process of, you know, lending, borrowing, a lot of corruption involved. Right? So, you know, that crisis, who is to blame? I mean, if you look at this, developing countries are to blame, right? These leaders were corrupted. Leaders in the developing country, they were corrupted. Entire system is corrupted, right? So that's why they have to go through these, right, structural changes, right? Even today, I mean, we are not sure which is really, right? Who is really to blame, right? Western system, Western, you know, lending system is to blame, or developing countries to blame, leaders of developing countries to blame, right? And inside the developing countries, there are tensions over, right, over reform. And even there is donor fatigue, right? These, assistance and, lending from major donor countries sort of becomes a subject of, tensions in developing countries. So I mentioned this. So this leads to the default in the late 1980s, right? Through this process, Latin American countries, they finally, suspended debt payments, right? Which is default. Then what happens? I mean, when this country sort of stop paying, suspended debt payments, what sort of could, Western countries, Western financial, institutions can do? There are some measures, right? There was no debt relief, right, in the beginning. There was no debt relief. So either in the form of debt swaps, right, instead of debt payment, sort of Western banks, they receive some guarantees, right, in the form of land and others, right, instead of debt payments. So there were debt swaps, or because debt relief was not an option yet. Okay. Then '89 new plan came out from the United States, which is the Brady Plan. Brady Plan, after Baker Plan, sort of a rescheduling all that, right? So a little bit of ingenuity built into this. So all that was exchanged for US government bonds, okay? So later they used these bonds for, right, in lieu of debt payments. So some ingenuity here. And this textbook discusses the United States played some hegemonic role. So by playing hegemonic role, the United States, to help out these Latin American indebted countries, the US, they didn't pay fully for Latin American debts, but the US made some sacrifices. That's hegemonic role. So partially resolve the debt crisis so that the global financial system not destabilized. Okay. Next, IMF began to play important role in the debt crisis. What role IMF play in the debt crisis? IMF policy was based on these neoliberal ideas. Okay, as long as developing countries open up their economy and be integrated into the global economy, that problem overcome. So IMF policy was based on these neoliberal ideas. And this is when the IMF sort of shifted from balance of payments, sort of a coordination, to more of a lender of last resort, okay, after the debt crisis. So IMF began to step in, actively resolve this debt crisis as a lender of last resort. Some role adjustment here, right? So the IMF role was making sure that extending, lending, but make it conditional, okay, upon some adjustment programs, structural adjustment programs, right? So before lend money, IMF makes sure that some, structural changes are made in the receiving country. This is IMF conditionality, right? IMF conditionality. So there must be a series of conditions or actions, right, from the borrowing country before they receive a loan, right? Otherwise, they cancel the loan, right? We know this. I mean, Korea went through this process. Then, what is the IMF debt plan, right? First, IMF requires countries to devalue currency. So number one, currency devaluation. Many developing countries, their currencies tend to be overvalued before open up, right? So when they open up, currency must be devalued, currency devaluations. I think it's also good to promote exports, right? When you have devalued currency, to earn incomes, right, you can promote exports. Second, this is not in the textbook. Textbook uses different term. Getting the price right. Many developing countries, currency is misvalued. Second, prices are not right in many developing countries. So the first thing the IMF economists recommended when they arrived in these debted countries, first thing they recommended is this: get the price right. Okay, get the price right, because many prices in developing countries are subsidized, right? So adjust the price to the international level. That's getting the price right. And next, cut the spending. Fiscal austerity. This is a recurring theme, right? In many developing countries, they tend to overspend, right? Also in Korea in 1997. In 1997, right before we were treated by IMF policy, I think Korean currency was overvalued. Korean currency was overvalued. And I'm not sure about this. Probably some prices are, I think, state managed, right? So not 100%. Korean price is international price. And whether or not the Korean government was overspending, probably still many companies were, state-owned at that time, and these state-owned companies had very, attractive sort of financial packages to employees, right? So these many government-owned companies, they were overpaying to their employees, right? Next, tariff liberalization. No doubt. It's making trade easier. Higher interest rates. Higher interest rates. Same thing. To cut the spending, you need to do this. You need to do this. And if you set interest rate higher, right, you can attract foreign investment. Higher interest rate, more foreign investment, right, which is important, which is what we did in 1997. So after which, we Koreans attracted a lot of foreign investment, too much foreign investment into different places. that's when I think the Korean stock market began to attract a lot of, hot money. Later became a problem, right? So higher interest rates. And we need good social programs, right? Because all these programs, all these economic programs are socially, right, shocking. So, government, they have to go ahead and sort of administer some social programs, social harmony programs, right? Now, so IMF was sort of transformed into sort of a very active, debt management organization, right? After that. Now then, I think that the second wave of financial crisis. So financial crisis in the 1990s, right? Mostly regionally in Asian countries, Asian region. How did it begin? It began, I think it is a balance of payments crisis, right? Financial crisis in the 1990s, balance of payments crisis. It was an investment bubble, okay? Investment bubble and speculation bubble. There was a speculation attack, right? So now financial market is much more, right, flexible, right? The size of financial market, much more transnational, unlike in the early 1980s. So developing countries now enjoy, a lot of foreign investment. And this foreign investment, right, becomes too hot, becomes investment bubble and speculation bubble, right? Then leading to crisis. This is, I think, the crisis in the 1990s. Then let's discuss how then BPC, balance of payments crisis, how balance of payments crisis lead to debt crisis. This is sort of a causal connections. Okay. So first, many developing countries, particularly in Asian countries, economic growth rate, unlike in the late 70s, early 80s, Latin American region was leading growth in developing countries in the 1970s, right? But in the 1990s, Asian countries were leading. Okay. A lot of investment opportunities in Asian countries. So it began with huge foreign investment into Asian countries. Okay. And at some point this becomes a bubble. Okay. Then there's a capital flight. Okay. When funds flow out of developing countries, then I think countries suffer extreme shortage of funds in the banks. Okay? Then interest rates go up. Then governments and banks in the developing countries, they are under extreme pressure to defend the value of their currency. Okay? Then to defend it, they exhaust, right? They exhaust their foreign exchange reserves, holdings. Right? After they exhaust the foreign exchange reserves, they devalue the currency. Okay? And when they devalue the currency, then it becomes that. right? Because, right, the value of your currency goes down overnight, then the payments, right, for lendings, right, enormously increase because of the devaluation of the currency. So this is the chain reaction of how balance of payments lead to debts in the developing countries. Then let's see how the Asian financial crisis, this is general theory, okay, general theory, then how this applies to the financial crisis in Asia in 1997. It began in July 1997 when the Thailand's currency, which is baht, suddenly collapsed. This was just, I mean, people didn't know it. This was just reported, one section of the newspaper, right? Just in passing, right? Then this was reported in the newspaper. Then I think before crisis, right? The Thai banks and companies, they borrowed again a lot of US dollars, right? A huge investment opportunities there in Thailand, right? Thai banks and companies, they could do this because of stable currency exchange rate. Thai baht was fixed to some good level, good value against the dollar, right? Because of that, they could do this. They could borrow, right? They could enjoy a lot of US dollars. Right? Foreign investors, simply they brought all this money into Thailand, invested in Thailand. This was possible because of this stable currency value. Right? Stable currency value and higher interest rates compared to the United States. Right? Because these funds are always looking for higher returns. But the problem began to occur. The problem began to occur when people found out many lendings. Okay, Thai banks, they borrowed a lot of US dollars from US commercial banks, right? They lended to Thai companies, right? Locally. But in this process, they found out a lot of bad loans included. A lot of bad loans. This is how the problem began to occur. A lot of bad loans there. In other words, bad loans meaning there's a lot of money lended out to many Thai companies, but at the end, many Thai companies could not pay back these loans. That's bad loans. This is the beginning of problems. And this rumor spread out, right? Was reported in some newspapers. Then foreign investors catch this, right? Foreign investors catch this. And then they began to pull out of Thai market, right? Pull their money out of Thai market. Because their only concerns are about, right, the value of Thai currency. Because their investment is made in Thai currency. Right? When Thai currency value collapses, they lose. So this is important for them. The government's willingness and ability to keep the value of Thai currency. This is very important for foreign investors. Right? So when they lose confidence in this, then there will be run run on the banks, run on the dollar, right? Then speculation attack begin, right? Which is what happened in 1997. That's also what happened in Korea, right? That's what happened in Korea. Then spread out to different countries, Turkey, Korea, right? The neighboring countries. Same thing, same process. This is typical process of speculation attack. Then what do? They convert their investment into dollars, right? Because they lose confidence in the Thai currency. They begin to convert into dollars. Then this happens. Then the Thai government's dollar reserves exhausted, right? Exhausted. We Koreans did it, 1997, same thing. This is speculative attack. Speculative attack. Very scary, right? Spinning out of control. Just, right? In the matter of a couple of hours, right? Now, so I think this chapter, sections of this chapter, does a very good job of describing what happened in Thailand. Very good description. Then finally, sort of a 25 baht per dollar exchange rate later becomes 50 baht, per dollar. Sort of twice lower the value, right? Then what happens, right? Thai people, what do Thai people feel about it, right? Then your imports, price for import, double, right? And same thing happened in Korea. At that time, I was in America. I was a graduate student, and I saw many Korean students after this speculative attack happened in Korea. Many students in the United States, because they were funded by their parents. Their parents sort of exchanging Korean won into dollars, then send it to their kids in the United States. Then Korean exchange rate at that time, as I recall, I think it began with almost 700 won per dollar. I'm talking about 1996. 1995, 1996. Korean won was very strong. Much too strong, overvalued Korean won, like a 600, 650. Right? On the average, 650 per dollar. Right? Very strong one. Was much too overvalued. Then 1997, crisis hit Korea. Then this, I think, first came down to like a 1,200 per dollar. And later, I think even down to 1,600. Same thing, almost half the value, right? So then I think the parents, they have to, send twice the money, twice the amount they were sending before the crisis. So many Korean students, they were selling cars they were driving, right? and they moved to cheaper apartments. Some, I think, even pack up, go back. I saw many of Korean students doing that. So that's, I think, exactly what happened in Thailand. I think same thing. Thailand, in Korea, Russia, same thing. Russia. 1998, Russia. Russian economy was recovering before that a little bit, but then financial crisis, I think, spread out to Moscow. Then same thing happened in Moscow, right? The assets of Russia simply, right, plummeted. It's very sad. Although Russia quickly recovered 1999 because of oil prices increase. That was very surprising. Since then, Putin came in, right? Then Russia enjoyed high economic growth rate until the global financial crisis. Now Russia is very, in a very difficult situation because of energy market changes, shale revolution. It's not currency issue, but Russian income as a government decreased 20%. Russian income, not because of currency, but because of energy market changes, shale revolution. Gas market is sort of a diversifying, right? In the past, Russia was monopolizing the market, but we have new entrants in the gas market. So Russia lost 20% of the income they were enjoying now. And Russia is expected to lose more. Maybe when America began to produce more shale gas and began to export LNG, then Russia will lose more income, maybe up to 50%, because they are losing markets, right? They are losing markets. So it's not currency, but it's energy market changes. Now, global financial crisis. Global financial crisis. So now I think that crisis, financial crisis in the 70s began with Latin American countries, right? Latin American countries. It's kind of sad. Crisis hit those countries that are ambitious about their development projects, right? It's kind of ironical. I think Latin American countries were very ambitious about big projects, government projects in the 70s, right? Although it ended up with failures. Then 90s, Asian countries and Russia, right? Then 2000s, U.S. suffered balance of payments crisis in the 2000s. We need a little bit of background explanation why America began to go under this kind of a problem. It was again, it was a debt problem. It was an excessive lending problem, and also ideology problem. Okay, it was an ideology problem. America was addicted to particular type of ideology, neoliberal ideology, right? And some, irrational behavior. Economic players, they were irrational. Some are unethical. And more than anything else, we need, right, strong governance, global governance system. Still, global financial system is not well governed, right? So we need strong governance system. A little bit of background explanation for the U.S. economy to understand, right, the financial crisis in America in 2007. In the 80s, neoliberal policy. Again, I think this textbook begins with 70s, right? Petrodollars, it begins with that, right? Then in the 80s, neoliberal policy. So under neoliberal policy, banks began to be deregulated. Deregulation of the financial market in the US. And by 1990, liberal ideas were well entrenched among the leaders, economic leaders in the United States. I think the authors of this textbook, they emphasize ideology and ideas very much, right? Why America, sort of implemented those policies? Because of ideology. Behind it, America had this ideology. Leaders, right, were addicted to a particular type of ideology. Clinton administration in the 1990s continued, right? Succeeded this neoliberal policy. And 1990s were important years in the sense that global economy was booming, okay? In general, the global economy was booming. And many countries were competing to attract huge amounts of unregulated hot money. Okay? There were huge amounts of unregulated hot money. In the 1990s, and this money moves around, right? Moves around, attacking South Korea, Thailand, right? Mexico, Brazil, Turkey, right? Things like that. There was an important institutional change in America. There was a merger between commercial banks and investment banks in 1999. There was a law passed in Congress which prohibited the mergers between these two institutions, commercial banks and investment banks. But after that, what was the bill called? Glass-Steagall Act. Right? Glass-Steagall Act was removed, which was banning this. Right? So then financial market was even more deregulated because of this. And 2000, 2001, the dot-com bubble, investment bubble, a lot of investment made into dot-com companies. And President Bush and Federal Reserve Bank Chairman Greenspan continued deregulation. There were some structural problems in the US economy. A couple of structural problems in addition to this deregulation and neoliberal policies. Number one structural problem facing the US economy was trade deficit. There's a huge trade deficit. Trillions of huge trade deficit. And second structural problem, right, I mean, because of trade deficit, I think trade surplus countries like Germany, right, Japan, those countries were loaning money to the United States. That's how the US economy was sustaining itself. You know how this works, right? And there's an imbalance, the deficit countries and surplus countries, right? The reason this imbalance can continue is that these trade surplus countries, they purchase U.S. Treasury bonds, right? So technically they were sort of loaning money, same thing as loaning money to the United States. And low interest rates. This is second structural problem. I think finally I want to emphasize page 221. Page 221. The author gives out 5 different reasons for the global financial crisis of 2007. Right? 5 different reasons. Number 1 reason, U.S. balance of payments crisis. Number 1 reason. Second, U.S. regulatory regime problem, right? That led to excessive debt and excessive lending, right? And third, myopic ideology. Third reason. Number 4, and irrational, unethical, and illegal behaviors of some individuals. Number 4 reason. And number 5, weak global governance. Number 5 reason. Okay? So remember these five reasons behind the global financial crisis. Okay, I think today this is enough.